Even though earnings season is just starting to get underway, investors are starting to notice a few things. Bob Pisani tells us what they are.
Earnings season is just starting to pick up steam, but already a couple of key trends are beginning to emerge. There's good news and bad news. The good news is, so far, companies continue to report earnings well above expectations. Just look at the companies reporting today. Comerica, BlackRock, Bank of America, United Health, all of them beat by very wide margins. Bank of America beat earnings estimates by more than 6%. Comerica beat by more than 9%. BlackRock, 8%. That's way above the usual 3% earnings beat for stocks in the S&P 500. Why such big beats? The analysts, fearing global economic slowdowns in 2019, dramatically slashed their earnings estimates last December, but the meltdown didn't happen. And now it's obvious that many of them cut the earnings estimates too much. But here's the bad news. There's a very large discrepancy between earnings and revenues. That's a sign that cost pressures are starting to show up in the equation. So right now, earnings are expected to be down 1.8% this quarter, but revenues are going to be up 5%. What's that all about? Companies that have reported have been citing an unfavorable impact from foreign exchange, a stronger dollar. But more importantly, many are now reporting issues with higher wage and higher labor costs, higher raw material costs, and higher transportation costs. Look at J.B. Hunt. This is a trucking giant, logistics giant. They cited all the above as cause for its big revenue miss in the first quarter. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.